Learn to Earn by Peter Lynch. Two Walmart employees. Same job. Same paycheck. Same starting point. 6 years later, one has a $22,000 asset and is moving into her own apartment. The other has a $6,000 clunker he doesn't even like anymore. And he's still living with his parents. Same income. Completely different outcomes. The difference wasn't luck. It wasn't a raise. It wasn't a rich uncle. It was one decision, repeated every single month. Today we're breaking down Peter Lynch's Learn to Earn, the book that taught a generation of ordinary people how to build real wealth through the stock market. Lynch managed the Fidelity Magellan Fund and turned it into one of the best-performing funds in history. And his message is simple: you don't need to be a genius to invest well. You just need to understand the rules of the game. So let's get into it. Part 1, The Things Schools Never Taught You. Here's an uncomfortable truth. American schools have failed us. They teach history, but not the story of capitalism. They teach math, but not the math that tells you whether a business will succeed or fail. Home economics. You'll learn to cook a turkey and balance a checkbook. But nobody ever teaches you how to invest. That's wild. Because investing is one of the most important skills you'll ever develop. Lynch points out that the people who've built real wealth through the stock market aren't Wall Street insiders driving Rolls-Royces. They're teachers. Bus drivers. Doctors. Carpenters. Regular people with regular jobs who learned one skill that most people never pick up. And here's something Lynch is very clear about from the start: there is no such thing as a natural-born investor. That's a myth. The principles of investing are simple. Anyone can learn them. The playing field is more level than most people think. So why doesn't anyone teach this stuff? Lynch doesn't have a clean answer. But his entire book is a response to that question. Part 2, The Story That Changes Everything, Joe versus Sally. Let's go back to those two Walmart employees. Joe Big Belly has been saving every dollar, not to invest, but to put a down payment on a $20,000 Camaro with a racing scoop on the hood. He borrows $18,000 at 10% interest. 6-year loan. $200 a month. At first, he loves it. Friends think it's cool. A few months later, scratches on the door, stains on the carpet, nobody's impressed. It's just a car. 6 years later, Joe makes his final payment. Total spent over $30,800, and that's before insurance, gas, oil, and maintenance. What does he have to show for it? A beat-up 6-year-old car worth maybe $6,000 that he doesn't even like. Now meet Sally Cartwheel. Works the checkout line a few feet away from Joe. Sally also saved $2,000, but she bought a used Ford Escort for cash. No car payments. So instead of sending $200 a month to a finance company, she invested Some people assume that when the rich get richer, the poor must be getting poorer. Lynch pushes back hard. When a company grows, it hires workers, those workers earn paychecks, and that money flows through the economy. When Steve Jobs built Apple, or Bill Gates built Microsoft, they weren't taking money from anyone. They were creating new value. Adam Smith described this in 1776 with his concept of the invisible hand. When millions of people pursue their own interests in a free market, supply and demand balance things out automatically, no king, no central planner required. The market figures it out. Lynch's core argument: the stock market is the single best tool ordinary people have ever been given to participate in that growth and build real wealth. The question is whether you use it. Part 4, What it actually means to own a stock. So what does it mean to own a stock? Most businesses in America, your local barbershop, the bowling alley down the street, are privately owned. You can't invest in them. But the biggest companies are publicly owned. That means anyone can call a broker and buy a share. Buy a share of McDonald's, and you're a part owner of over 10,000 hamburger restaurants. The company has to send you reports. They invite you to annual meetings. They may pay you a dividend, a portion of their profits, directly into your pocket. If McDonald's keeps growing and selling more Big Macs, the stock price goes up and you can sell for a profit. If things go badly, the price falls. There are no guarantees. But that's the deal, you share the risk, and you share the reward. Every morning, investors open the business section and look for one number, the closing price, the price of the last trade before the 4 p.m. bell. You'll also find the 52-week high and low, dividend info, and something called the P/E ratio. The P/E ratio, price divided by earnings per share, is one of the most important tools in investing. If IBM trades at $100 and earns $10 per share, you're paying 10 times earnings, relatively cheap. If it earns only $1, you're paying 100 times earnings, way too expensive. In the mid-1990s, the average stock had a P/E around 16. Fast-growing companies carry P/Es of 30 or higher. Slower ones carry lower P/Es. The P/E tells you what you're paying for every dollar of earnings. Learn to use it. Part 5, Mutual Funds, the Smart Shortcut. Not everyone wants to research individual companies. Lynch gets that. And for those people, he's enthusiastic about mutual funds. Here's how it works. A mutual fund pools money from thousands of investors. A professional manager takes that pile and invests it across dozens, sometimes hundreds, of companies. The moment you buy in, you own a small piece of all of them. You can start with as little as $50 or $100. And you can invest on whatever schedule works for you. Lynch recommends something called dollar cost averaging. Simple idea, invest the same fixed amount every single month, no matter what the market is doing. When prices are low, your fixed amount buys more shares. When prices are high, it buys fewer. Over time, your average cost per share stays reasonable, and you avoid the trap of dumping all your money in at exactly the wrong moment. 2 things to watch for when choosing a fund. 1. The load, an upfront sales fee of 3 to 4% on some funds. No-load funds charge nothing to enter and perform just as well. Skip the load. 2. Annual expenses. Every fund takes a percentage of assets each year. Below 1% is good. Higher fees compound against you the same way good returns compound for you. And Lynch's simplest recommendation of all. The index fund. An index fund has no manager making decisions. It simply buys every stock in a given index, say, the S&P 500, and holds them. No trading costs. No management fees. No decisions. You always match the market average, which, over time, beats the majority of actively managed funds. Lynch's suggestion: split your money between an S&P 500 index fund for large companies and a Russell 2000 index fund for smaller ones. Set it, keep contributing, don't touch it. One warning, don't be a fund jumper. Last year's top fund rarely repeats. Find one with a long track record and stick with it. Part 6, Picking Your Own Stocks, the 5 Methods. If you want to go further and pick your own stocks, Lynch walks you through 5 methods, from worst to best. Level 1, the dart method, literally throwing a dart at the stock page. Pure luck. No basis for building anything. Level 2, hot tips. Your friend, your uncle, someone on the bus says this stock is a sure thing. Most hot tips are pure air. People who research a $50 toaster for hours will throw thousands at a rumor. Don't. Level 3, educated tips. Following expert recommendations from TV or financial magazines. Better than Uncle Harry, but the expert may change their mind without telling you. You could hold a stock long after they've sold it. Level 4, the brokers buy list. Full-service brokers have research teams that issue buy, sell signals. If they change a recommendation, they'll tell you, that's a genuine advantage. But always ask, what's in it for the broker? Make sure the recommendation serves you, not just their commission. Level 5, do your own research. This is Lynch's highest form of investing. You study the company inside and out. You understand the product, the competition, the finances, the management. You're not relying on anyone else's opinion, you've formed your own. And here's the twist. Lynch believes ordinary investors have a massive advantage over professionals in one specific area: everyday observation. Invest in what you know. This is Lynch's most famous idea. You don't need a Bloomberg terminal to notice that a new restaurant always has a line out the door. You don't need a Wall Street analyst to see that everyone in your school switched from Reebok to Nike. You don't need an MBA to walk into a store and notice whether the shelves are full and the customers are happy. These real-world observations are where great investment ideas begin. Then you follow up with the numbers. Before risking real money, Lynch recommends a fantasy portfolio. Pick an imaginary $100,000, spread it across companies you find interesting, and track your picks for months. Learn to follow quarterly reports and develop your instincts without real stakes. Part 7, Knowing the Story, Nike and Johnson & Johnson. Here's what separates good investors from bad ones: knowing the story behind the stock, and not confusing the price with the story. Most investors use price as their only signal. Up. Must be great. Down. Must be terrible. Lynch calls this the single biggest mistake an investor can make. The price is not the story. The story is what's actually happening inside the business. Let's look at two real examples. Nike, 1987. By 1987, Nike had been struggling. Sales down 22%. Earnings down 38%. Future orders down 39%. Ugly on paper. But Lynch noticed something when he looked up from the numbers: sneakers had become a cultural phenomenon. Toddlers, teenagers, adults, everyone was buying them. Tennis shoes, running shoes, basketball shoes. The demand was clearly growing. Then, in the fourth quarter report of 1987, one number changed: future orders turned positive. Stores around the world were ordering more Nikes again. That was the signal. The turnaround was beginning. Then came October 1987. The market crashed. Nike fell from $12.50 to $7. Investors who confused the price with the story sold everything. Lynch saw it differently. The story was improving. The crash was a gift. From $7, Nike ran to $90 over 5 years. 12 times your money. Johnson & Johnson, 1994. Same principle, different situation. In early 1994, J&J's stock had been falling, from $57 to $39, even though the fundamentals were outstanding. 10 straight years of rising earnings. 31 straight years of dividend increases. Heavy R&D investment. 34% of sales from products launched in the last 5 years. So why was the stock falling? Fear. Congress was debating healthcare reform. Investors dumped healthcare stocks across the board. But Lynch read the annual report. Over 50% of J&J's profits came from international operations, untouched by U.S. policy. Another 24% came from consumer products like Band-Aids and shampoo, nothing to do with drug reform. The threat was dramatically overstated. J&J was trading at 11 to 12 times earnings while the market average was 16. Lynch recommended it publicly in USA Today. The stock dropped a little more, then turned. By 1995, it was above $85. More than doubled in 18 months. The lesson from both stories? When the price falls but the fundamentals are intact or improving, that's not a warning sign. That's an opportunity. Part 8, Bear Markets, Crashes, and Why Staying Put is the Hardest, and Smartest, Thing. Let's talk about the moment that separates long-term investors from everyone else, the crash. Since 1900, the stock market has had 53 corrections, drops of 10% or more from a recent peak. One every 2 years, on average. About 15 turned into full bear markets, drops of 25% or more. Roughly once every 6 years. They're coming. You can't avoid them. And here's what Lynch wants you to remember: corrections aren't dangerous. Panicking during corrections is dangerous. When prices fall, people who claim to be long-term investors suddenly reveal themselves as short-term panickers. They sell at the lowest prices, not because anyone forced them to, but because they're scared. They volunteer to lose money. Here's the data. During a 5-year stretch in the 1980s, disciplined investors earned 26.3% per year. But most of those gains happened on just 40 out of 1,276 trading days. If you were out of the market on those 40 days, trying to avoid the next downturn, your return collapsed from 26.3% to just 4.3%. A bank savings account would have beaten that. You cannot predict which days the market will surge. You have to already be in it. Lynch tested the ultimate question: does timing even matter? Investors who always bought at the absolute peak versus those who always bought at the absolute low, the difference in annual return was just 1.1%. Stop waiting for the right time. Set up a schedule. Invest a fixed amount every month. Ignore the noise. Let time do the work. Part 9, Earnings, the only number that truly matters. At the foundation of everything Lynch teaches is one idea. The price of a stock follows the earnings of the company. Always. Eventually. When earnings grow, the stock will go up. Maybe not today. Maybe not this quarter. But over time, it will. When earnings fall, the stock will follow. Tracking the stock price without tracking earnings is like watching the scoreboard without knowing which team you're rooting for. Historically, U.S. companies have grown earnings by about 8% per year on average and paid 3% back as dividends. That's where the stock market's long-run return of 10 to 11% per year comes from. No magic. Just compounding business growth. When a company earns a profit, it has 4 choices. On 1, reinvest in the business. Open stores, build factories, expand. For a fast-growing company earning 20% returns on capital, this compounds your investment most powerfully. Option 2, waste it. Corporate jets, marble bathrooms, inflated salaries, overpriced acquisitions. Red flag. Destroys shareholder value. Option 3, buy back shares. Fewer shares on the market means your piece of the pie grows. Earnings per share rise. Stock price follows. J&J bought back 110 million shares over a decade, textbook execution. Option 4, pay a dividend. Cash sent directly to you on a regular schedule. Signals slower growth, but puts real money in your pocket. And in a bear market, that dividend check gives you a reason to hold on instead of panic selling. Part 10, The Warren Buffett Proof, and the final lesson. Lynch closes with the most powerful proof that everything in this book works: Warren Buffett. At the time Lynch wrote this, Buffett was the wealthiest person in the United States. He made his fortune doing exactly what this book teaches: no secret algorithms, no insider tips, no complicated derivatives. Just finding great companies, buying at reasonable prices, and holding on patiently for decades. His core holdings were companies you've heard of: Coca-Cola, Gillette, The Washington Post. Companies any ordinary person could have researched, understood, and purchased. $10,000 invested with Buffett 40 years ago turned into $80 million. That's not a typo. That's what happens when you combine time, discipline, and ownership of great businesses. Lynch's final message. Wealth is not built by predicting the future. Not by timing the market, finding hot tips, or obsessing over stock prices. It's built by 3 things. Saving early. Owning great businesses. Giving time the chance to work. The earlier you start, the easier the journey becomes. $1 invested at 20 does far more work than $1 at 40. You don't need a finance degree or a Wall Street connection. You just need to start. If this resonated, the full book is worth your time, especially if you're just starting out. Lynch writes like he talks, plain, direct, and packed with real examples. Hit subscribe.